Yeah. Hello, friends. Welcome to our Indigolearn session on amalgamation. So it's really heartening that we are having a discussion regarding amalgamation of CA Inter. So let's just wait for a few minutes for our friends to join in. Broadly, in today's discussion of 1 hour, what we are expecting to cover is topics on how amalgamation related questions get tested in the examinations and how you are expected to approach them. So that's what we will be touching upon. We got questions from, like always, we got questions from across different parts of India. I will try my best to answer as many as possible in this 1 hour. So till now, I think we consolidated the questions, and if you have any further questions, please add them or please send them across to us, and we'll try our best to answer as many as possible. Right, so let's get started. So Charan sent a question yeah, so this is a question that Charan sent. Charan sent it from a place called Rajamandri. So Charan's question is, sir, what is the logic for old companies' books in an amalgamation? So Charan, good question. I hope, just a moment, there is some, just a minute guys. I mean, there is some problem with YouTube, what some friends, I just need to look into that for a moment. Just give me a moment, I will continue. So fine, so let's get started. So Trent's question is, sir, what is the logic for old companies' books in the case of amalgamation? So Charan, the answer is this. So there is no accounting standard for closing the books of old company. You have accounting standard only for closing the books of, for opening the books of new company, but you don't have any entry for any journal accounting standard for closing the books of old company. So what you need to bear in mind is when you are closing the books of old company, the fundamental logic is this. Every component of your balance sheet of old company needs to be dismantled. That is the logic that you have to understand. So what does it mean? There is a balance sheet for old company. Ensure that every item, so assets you have, asset whatever you have, liabilities whatever you have, all those assets liabilities in the old company should be transferred from balance sheet into the realization account. So what is happening in the process? When you transfer the assets and liabilities from balance sheet into the realization account, that account gets closed, right? Then share capital, reserves and surplus. If it is equity share capital, you will transfer to equity shareholders account. Reserves you will transfer to equity shareholders account. And preference share capital, if any, you will transfer to preference shareholders account. Then if the cash balance is taken over by the new company, then cash balance should be transferred to realization. If it is not taken over, it will remain and you will prepare a cash account. So the main point you have to bear in mind is when you transfer just from balance sheet into realization account or these respective accounts what I spoke about, automatically the double effect is taken care. The main point is regarding recording the purchase consideration. So when you talk about recording purchase consideration, this is where generally students miss out on logic. The journal entry what you have to pass for purchase consideration comes from this logic. What is that logic? You are selling off an asset. Selling off not just one asset, a big bundle of assets called as business, right? So when you are selling off assets, what is the journal entry you need to pass for selling an asset? Well, I am selling off an asset, I am selling off a car. What entry will I pass? Car account should be credited. What should be debited? The person who is purchasing, that person's account should be debited if money is yet to be received. If money is already received, then you have to debit the account, or you have to debit cash or bank account. That is what you should do. So here also what I will do is I will debit the person who is purchasing it, purchasing company is purchasing it. So purchasing company account debited, purchasing company account debited to the assets. What are the assets that are going out? Assets which are going out could be fixed assets, current assets. If some liabilities are also going out, then liabilities going out means you will debit liabilities, right? So net assets is what are going out. So those net assets you will have to suitably credit. So So net assets when are going out, assets will be credited, liabilities if any will be debited. So with that, which account is getting debited by the way? Overall, you are debiting the purchasing company account. So you sold car on credit, later you received money for it. What entry do you pass later? Bank account to debtor. Same way, or bank account to the person who purchased car. That's all. That's what I mean. Now here also, if money is received, you will write bank account debited to purchasing company account. But if money is not received, if shares are received, then what do you write? Don't write share capital. Investments in equity shares of purchasing company account debited. Investments in preference shares of purchasing company account debited. If any debentures are received, investment in debentures of purchasing company account debited. Then if any cash is received, cash or bank account debited to purchasing company. So that is what basically you are recording. I hope the logic is clear to everybody. Right. Then let us move on to the next point. The next point is regarding closing the books. Charan, once we discuss that point, I think your doubt should be resolved fully. When you are closing the books, please understand, you have to first close the preference shareholders account if you have already prepared one. Why? Any balance in the preference shareholders account should be transferred to realization. Listen, this is one of the common mistakes that students make. That is why I am touching upon that more carefully. If there is any preference shareholder account opened, then close preference shareholders account, transfer the balancing figure in preference shareholders account to realization account. After that, close realization account and transfer to equity shareholders, close cash or bank account, transfer to equity shareholders, and ultimately equity shareholders account should tally. Alright, so this is the logic which we are expected to follow, Charan. So I hope this point is clarified. Let us move to next question that we have. This next question is from Vinay from Guwahati. So Vinay's question is, sir, why do we have different entries for amalgamation in the nature of purchase and amalgamation in the nature of merger? Vinay, this is exactly the question what I had when I was doing my CA Inter or IPCC as we call it. Now, the logic is very simple. When you are using amalgamation in the nature of merger, the principle is if A and B are merging, A should not make profit in the transaction, B should not make profit in the transaction. They are coming together. After coming together, they want to make profit. So whatever gain they want to make should not be from the transaction. The gain should be after the transaction is entered into. That is why when these companies come together, you don't say it is A purchased B, A merged with B is what you say. And if you look at the accounting also, look at how it is done. You are not saying, oh, purchased at book value or market value, nothing like that. If it is amalgamation nature of merger, you are assuming that it is taken over at book value only, right? So that is what is happening if it is amalgamation in the nature of merger. And one more point, most importantly, the principle, core principle is if it is amalgamation in the nature of merger, the revenue reserves of old company should continue ideally even in the new company. What do I mean by that? If P&L account was there in the old company, P&L account should continue even into the new company. So in amalgamation in the nature of purchase, you don't take anything like P&L account, general reserve, etc. don't come into the new company, right? But when you talk about amalgamation in the nature of merger, P&L account, general reserve, etc. these items also come into the books of old company, come into the books of new company. So when in our amalgamation classes what we discussed, I gave you detailed examples on how you have to approach this, but principle is this with respect to amalgamation in the nature of merger. In purchase, it is very simple. Just view it as you buying a big asset. What is that big asset you are buying? That big asset you are buying is business. That's all. So when you are buying that asset, why do I care at what value the old company recorded in their books? I will only talk about at what value it makes sense for me to record it. So that is why in amalgamation nature of purchase, we always record this at the fair value or basically the agreed upon value on the date of acquisition. So that is one small point what we got questions from. That is answered. Then there is one more question. Yeah. So the question is goodwill or capital reserve? Why? Look at how beautifully your students ask questions. Goodwill or capital reserve? Why? Why expense of amalgamation adjusted against these. Okay. So I think I understood your question. I don't know who sent this, but the question is this. So why do we have goodwill or capital reserve, and why do we have expenses of amalgamation adjusted against these? Friends, listen. Principle of goodwill, capital reserve, first of all, are expected to arise when here there is amalgamation nature of purchase. Okay. Say there is a pen like this. This pen is worth 100 rupees. I paid to purchase this pen an amount of 100 rupees exactly. So 100 rupees went out, 100 rupees per pen I got. So what has happened? What I paid and what I got are same. Then there is no goodwill or capital reserve. Clear? This pen is worth 100 rupees. I paid 120 rupees to acquire this pen. Then I will say that excess of what I paid over what I got is what is goodwill. Alright, so excess of what I paid over what I got is 20 rupees. So the 20 rupees will be goodwill. On the other hand, capital reserve means this pen is worth 100. I paid only 70 rupees to purchase this pen. So a 100 rupees pen I got by just spending 70 rupees. That extra 30 rupees, or basically that saving of 30 rupees is what we should not credit to P&L. We will call it as capital reserve. Fine. So keep this aside. So capital reserve is excess of what we get over what we pay. Goodwill is excess of what we pay over what we get. I hope you are clear to this extent. Now, imagine in a case we actually paid more than what we got, and the excess what we paid is 20 rupees. 120 we paid and got an asset worth 100. So excess what we paid is 20 rupees. So that 20 rupees we considered as goodwill. Goodwill is an asset which you will separately capture. If there are any amalgamation expenses what you are incurring, you know how we can simply understand it. It is as if to purchase those assets, you paid not just 120, you paid 120 to the company which sold those assets to you. You paid extra some 10 rupees of amalgamation expenses in the process to acquire that. So ultimately from your pocket, how much went out? From your pocket, ultimately in this transaction, 130 went out and you got assets worth only 100. Then what will happen? 20 plus 10, 30 will be goodwill. Are you clear about the logic? Right? Then what if a transaction is opposite? So the worth of this pen what you got is 100, but you paid only 70. You paid only 70 as purchase consideration. In such case, what we can say is you paid 70 to get this 100 rupees worth pen to the seller of that particular asset. In addition to this, you paid extra amount of 10 rupees towards expenses. So totally how much did you pay? 70 plus 10, 80 rupees you paid, correct? So the net excess what we are getting over what we paid should only be 20. So 20 should be considered as capital reserve closing balance. But what was the capital reserve earlier balance? Capital reserve balance earlier what we had was 100 minus 70, 30 was the capital reserve. Now what we did when we incurred these expenses, we debited this to capital reserve, thereby capital reserve became 20. So that is the logic why you debit these amalgamation expenses to goodwill or capital reserve in case of amalgamation in the nature of purchase. Alright, so let me move to the next question. The next question is regarding, so this is purchase consideration. So this is asked by Vinita Sharma. Vinita Sharma wrote this from Mumbai. Her question is, sir, purchase consideration is always confusing. What a wonderful way to start this. Purchase consideration is always confusing. Sometimes it is given directly, sometimes it is given as swap ratio, sometimes it is given as intrinsic value. How should we calculate? I think Vinita Sharma, you asked the entire amalgamation logic in one question, and now we need to understand that. See, generally in amalgamation, purchase consideration is one area where you have to be a little more careful while solving. So let me just quickly talk about Vinita's doubt. How do we deal with purchase consideration? If you understand the logic of purchase consideration perfectly, I can tell you, you are good with amalgamation. Because rest of it is very simple. The main trick, main challenge is regarding purchase consideration only. Fine. So if it is directly given. So I want you to have a framework in mind. I discuss this as a part of my class also. And I just want you to have this framework in mind. Whenever you think of purchase consideration, have two parties in front of you. First party. You are talking about The person who is receiving it. The other party is the person who is paying it. Okay, like this there are two parties. Between these two parties, you will ask a few questions. Payment to whom? Payment to whom? Payment in what form? Payment in what form? And then amount, basically some workings you will do and arrive at the final amount. That is what it is. So payment to whom? Payment in what form? Payment to whom means if this amalgamation related purchase consideration you are calculating, understand whether it is purchase consideration calculation in the books of old company or new company, it will be same. What did I say just now? Whether it is amalgamation calculation of purchase consideration for old company or new company, it will be same. Why? If I say that I bought this pen at 100 rupees, the one who sold it to me will say, yeah, I sold this pen to SathyaRaghu at 100 rupees only. So basically, the value at which this pen is sold to me is the value at which I bought it. So basically, that purchase consideration is not accounting. Purchase consideration, when you talk about, it is regarding valuation. So friends, please understand, this valuation does not change whether it is old company's books, new company's books, amalgamation in the nature of purchase, amalgamation in the nature of merger. All these things will come much later in accounting. First point is valuation. In valuation, it doesn't matter whether it is amalgamation in the nature of purchase or amalgamation in the nature of merger. Whether it is old company's books, new company's books, in all these cases, purchase consideration is standard. That point you need to get very absolute clarity on. Right. Then let us move to the next point. After having clarity on this point, with respect to purchase consideration, if the purchaser means the one who is buying, when the one who is buying will pay, right? Payment to whom? Payment to whom? Purchase consideration is what we pay, we are the buyers. What we pay to the shareholders of selling company. Remember this golden rule, because there is one more doubt regarding this which a student asked. I will talk about that later. Purchase consideration is always paid to the shareholders of selling company. Who is paying to the shareholders of selling company? It is paid by purchasing company to the shareholders of selling company. Fantastic. Now, purchasing company, selling company, whatever is paid to the shareholders of selling company, we will call as purchase consideration. If I pay to the shareholders of selling company in the form of equity shares of selling company, equity shares of purchasing company, that will be called purchase consideration. If I pay to the equity shareholders of selling company in the form of preference shares of purchasing company, that is purchase consideration. So the point is payment to equity shareholders of selling company. In what form? You can pay them in the form of equity shares or preference shares or debentures or cash, or you can just give some other asset to them. You can do anything, some consideration. Whatever is paid to the shareholders of selling company will be called purchase consideration. Then you know how you should do? Payment to equity shareholders. Then equity shareholders of which company? Selling company. After that, payment to preference shareholders of selling company. Then, will you talk about payment to the debenture holders of selling company? No. Why do I say that? Because payment to equity and preference shareholders only will be considered here. Payment to debenture holders, etc. will not be considered. That said, pay utmost attention. Payment to preference shareholders and equity shareholders will be considered. That payment can be made in the form of equity shares or preference shares or debentures also. So you can give debentures from the new company to the shareholders of selling company. That is perfectly fine. But settlement made to debenture holders of selling company will not be called as purchase consideration. I hope that point is clear. Now, coming to the question on directly, if it is given, how do I calculate? If it is not, using swap ratio, how do I calculate? Let me answer that point. If it is directly given, you are the luckiest person on the planet if purchase consideration amount is directly given in the question. Because very rarely that happens in our examination. Fine. Say you are that lucky person and it happened. You just take whatever is the purchase consideration given in the question, that you will consider and conclude the problem. Now, but as I told you, it's a very rare probability. Generally, the purchase consideration calculation is expected out of student. So student has to calculate, say using swap ratio or intrinsic value, you have to calculate the purchase consideration. How does that calculation work? Listen. The biggest problem that I keep seeing again and again in the answer sheets of students is the way in which you approach the purchase consideration, you make an assumption which is not there in the question. Please don't, you should not write what you want to write. You should solve the problem based on how examiner is asking you that question, right? So considering that, friends, please be careful when you are answering the problems of purchase consideration. When swap ratio is given, for 3 companies or 3 shares of old company, 2 shares of new company will be given. What does it mean? For 3 shares of old company, 2 shares of new company will be given. Take that point into consideration. Just see, forget this by-hearting process. Old company by new company by old company. Don't do all that by-hearting. Just go with the logic. What is the logic? If 3 shares are there in old company, 2 shares of new company will be given. If there are 1 lakh shares in old company, how many shares will be given? Or if there are 3 lakh shares in old company, how many shares will be given? So you will do a simple cross multiplication and arrive at how many shares will be given in the new company. Watch out, there are 2 things which you need to bear in mind here. How many shares to give is one calculation. At what value to give is another calculation. Lot of times, okay? How many shares to give comes from swap ratio. If that swap ratio is given, that how many shares to give to the shareholders of old company from new company, that comes from where? That comes from swap ratio calculation, whatever is given to you. After that is given to you, you have the next point. What is the next point? These many shares are to be given. At what value should we give those shares? That also you need to understand, right? So to decide at what value you need to give those shares, you need to consider the principle what I am now going to talk about. What is the principle? First, if any agreed upon value is given in the question. So it's given in the question that shares of old company or selling company should be considered at 20 rupees. Shares of purchasing company should be considered 30 rupees. Friends, that is your ultimate document. That is your ultimate information. You just have to follow that. So if any information regarding the price is agreed upon in the problem and given to you, trust it. That is the most reliable information. If that agreed upon value is not given to you in the question, then you come to the next one. If agreed upon value is not given, then which value should be considered? If agreed upon value is not given, go to the next best, that is, you will consider the external valuation. Say, we don't have the exact value agreed upon between 2 parties. But the question tells you that this share of selling company is traded at 50 rupees in the market. Share of purchasing company is traded at 75 rupees in the market. You know what it means? Examiner is indirectly giving you the value at which that purchase consideration is to be computed. So if the problem is silent about the value at which the transaction or value at which the shares have been allotted, that information is not given, then please consider this aspect. First you are taking the agreed upon value. If agreed upon value is not there, then you will take external value or market value per share. If that is also not there, then you will look at something called as intrinsic or internal value per share. Students keep asking me, sir, for one company maybe external value is given, for one company external value is not given, then what should I do? Friends, if for one company external value is given, for that company you should consider external value given in the question only. And for one company, if external value is not given, maybe only for that company you need to calculate using intrinsic value. So if, even in these 2 companies, if for one of the 2 external value is given, please go with that. Only if external value is not given, you will come to intrinsic value. And when you are doing intrinsic value, lot of times students get confused between intrinsic value and book value. Intrinsic value is not book value. What is the meaning of intrinsic value? I don't know, say for this pen, I don't know what is the external value. Then you know what I should do? I should take this cap independently. I should take it to market and ask, if I just sell off this cap, how much will I get? Then I should open the refill and go to market and ask, if I just sell off this refill, how much will I get? Then I will take the rest of the body of the pen to the market and ask, how much will I get? Just imagine the same thing as company. Plant and machinery you are taking separately. Then checking what is today's worth of this in the market. Then you are taking some other asset of buildings or whatever to the market and checking what is the value you will get from this. Like this, you will ascertain today's worth of these assets, and based on that value you will decide, oh, this is the worth of the assets. For these assets, what is the value we are going to get, and that value you will consider for the calculation. I hope you are clear about it, okay? So you will consider intrinsic value per share. So I hope this doubt is clarified. So we spoke about purchase consideration, how it is supposed to be done, right? So I would just take a 2 minutes break and then we will resume this beautiful discussion.